Everybody, this is Rob Keents with the Freedom Report, formerly Gold Silver Pros. For those of you who have been following me for several years, we're doing the weekly market wrap up. It is Tuesday, August 20th, 2024. And the theme of today is going to be, let's take a look at how bad or good the economy is. And let's take a look at what other governments are doing with currencies. And let's take a look at what's going on with gold and silver. I'm going to bring you some information on the ETFs. It's about time we circle back around. We're going to show you what the gold and silver price were in China as of the latest report this morning that I got from Twitter. And we're going to go over some economic data, lots of stories today. So let's jump right into it. As I look at the economic data, really the only thing that kind of grabbed my attention from last week was the optimism index. I think we might have covered it. It was up slightly. There's a little bit of optimism in the air. Jobless claims were down just a bit, although we don't agree with those. We think that those are bunk numbers, but we'll see, next month how the overall jobs report comes out. Capacity utilization, which is how much we produce as per how much capacity we have in the economy, was down slightly from 78.4% to 77.8%. All of these came out last week. Housing starts were down to 1.24 million. And to bring you up to date with the economic data we have this week, the only thing that really interested me was U.S. leading economic indicators, which I'm going to go over in a little bit more detail right before we get into the gold and silver section, because I've got some charts for you on that. That's down a little bit. In fact, 29 months down. We'll get into details of that here in just a moment. Looking at the markets, today the markets are down. I'm reporting about 2:30 Central Time when I'm recording this. The Dow Jones is down about 64 points to 40,831.56. S&P is down 9 points to 55.98. NASDAQ is down about 48 points to 17,827. And the Russell 2000, the small caps, down about 19 points. So overall, the stock market has its S&P 500 first losing day in 9. So there was a comeback rally after that sell-off. It's losing a little bit of steam. We kind of plateaued there. We'll see what happens in the stock market going forward. For those of you that remember when 𝙁𝙍𝙀𝙀 came on the program, Elliott Wave analyst back 4 or 5 months ago, and predicted that we'd have the stock market swoon in the summer. I'm going to bring him back on, and we're going to get thoughts leading into the last few months of the year and what he sees for the rest of 2024, now that some of that data is out over summer that we talked about earlier. So stay tuned for that. We'll do that the first or second week of September. That'll give you a good preview going into the fall about what's going to happen in the equity markets. Back to our report today, though, looking at the bond market, we did have the 2 and 10-year come up a little bit from last week. I'm trying to get the bond charts loading here at CNBC. It doesn't want to. There's still a yield curve inversion between the 2 and the 10-year. It means the 2-year is a higher rate than the 10-year. That's usually a signal of recession. The 2-year hit 4% today, back up to the 4% mark. Right now, as time reporting, is at 3.996, effectively still 4%. And it did hit 4 even a couple hours ago. The 10-year is at 3.816. Again, the rates are not elevated. The bond market's being maybe a little bit Pollyanna as to what's going on in the overall economy, but overall still slightly elevated interest rates. And it'll be interesting to see. There have been some interesting opinions, as to whether the Fed will ease, because Europe is easing. Some other countries are easing. So the world overall net of everything, most of the economies are in an easing period where they're trying to pump some money into the economy to keep it up, because we started to go into that recession. We were headed that way. So there's a lot of easing in other currencies, a lot of easing in other lower interest rate debt conditions across the world. And so will that put pressure on the Fed to do a cut here early September? A lot of people think so. The market's certainly pricing it in and wanting it to happen. I think that's part of what the rally in the stock market's been the last 7-8 days. But I think that if the Fed doesn't, boy, it could reverberate. I think they probably will, because election cycle. But we'll see. We'll see what happens. Bitcoin is up 423 today to 59,419. The high earlier this year, I believe, was March 12th. It hit 73,000 something. So it's about 14,000 down since it's high, but it's up for the year. And we'll talk about a little bit more on that here in a moment. As we look at the rest, Litecoin is at trading 64.61. I'll go through some of the others. XRP at 60 cents. So that's up. It's been averaging 40 to 50. So that's a nice little bump for XRP. Dogecoin, 10 cents. Lots of different coins. We won't go over all of them, but overall the cryptos are up slightly today. Gold is doing very well. We'll talk about that as we get later into the report. So overall, the markets took it on the chin last week, kind of came back this week. The economic data doesn't really tell us that everything's rosy. In fact, it's worse as we get into the stories. I wanted to take a look at the stock market sell-off after the fact to see what people were writing about it. So we've seen some stories in late June, early July talking about what was happening underneath the stock market, who was doing what. And I came up with the hedge funds. So I'm looking at an article at Reuters, published July 1, 2024 by Carolina Mandel. The title of this Reuters article is Hedge Funds Dump Tech Stocks at Fastest Pace Since 2016, Bank Shows. We did kind of cover that, but I wanted to read you a couple of quotes from this. It says here, global hedge funds in June sold U.S. shares of technology, media, and telecommunications companies at the fastest pace since 2016, mainly driven by semiconductor stocks, Goldman Sachs said in a note. This is according to Reuters.com. The sales could indicate that portfolio managers have become more bearish on tech stocks after the sector's powerful rally in the first half of the year, although the note does not provide any reason behind the trend. The bank, which compiles its client positioning for the data, says semiconductor and software were the two most sold sectors in June, while hedge funds increased their allocation to tech hardware and electronic equipment. Overall, Goldman Sachs said hedge funds net sold global equities for this third straight month. So hedge funds have been doing the selling. That's why we had the tech stock pullback and the stock market pullback that we had. Looking at a Bloomberg article around the same time, June 27th, by Michael Sika, M-S-I-K-A. Hedge funds sell tech stocks aggressively, Goldman says. Net selling of tech in June on track to be worst on record. So Goldman had been reporting it out. Looked at an article from hedgeweek.com. Hedge funds sell off U.S. cyclical stocks at fastest rate of the year. Quote from the article, hedge funds sold off U.S. cyclical stocks at the fastest rate seen so far this year, last week, also kicking off their largest sell-off of U.S. industrial stocks in more than 10 years, according to a report by Morningstar. This is on May 30th. So industrial stocks stole off first, then the tech stocks, and that's why we had the pullback. And again, reported from Goldman Sachs. Another reason for the pullback that I found, and I think there's a couple of issues. I think this one I'm about to talk about drives the behavior of the hedge funds. It's like, why did the hedge funds sell stocks? There's had to be a reason. We're just tired of the tech story it's been going for 14, 15 years, or was there another reason? Well, according to an article by Brandon Smith via altmarket.us, he was talking about the carry trade trap. Now, I did talk about the carry trade last week with Japan. Listen to Brandon's explanation of the carry trade. He does it very simply. I think it's beautiful. So I'm just going to read. Quote, carry trades refer to operations in which investors borrow in a currency with low interest rates, such as the Japanese yen, and reinvest the proceeds in higher yielding assets elsewhere, such as the U.S. The strategy is a considerable driver of U.S. stock markets and has kept stocks alive despite the Fed's removal of QE. So carry trade was very big in keeping the stock markets pumped because people would borrow money from Japan, basically zero interest rate or close to it, and then invest in things in the U.S. because they got a higher return. We talked about that last time. Continuing from the article, this month's stock plunge, meaning August, was triggered by fears that the Bank of Japan might hike interest rates, coupled with expectations that the Fed will cut rates in the near term due to the recession threat. This would kill the carry trade that has kept stocks going. To prevent a destructive carry trade unwind, the Fed would have to coordinate with the Bank of Japan and introduce a new stimulus program to soften the blow. But as the author mentions above, if the Fed returns to QE, inflation will skyrocket again. The public will demand an explanation as to how it's possible for there to be a deflation in markets and jobs and inflation in prices at the same time. The Fed won't have answers for them. It's a catch-22 on top of a catch-22 ending up. This is what Brandon says. I believe there's no way out of the situation, and the central banks deliberately maneuvered the U.S. into a predicament. The only thing left for them to do is pull the plug when the timing is most advantageous. After the elections makes the most sense, especially if conservatives come out on top and there's a red sweep in 2025. He believes there's a political connection to the way the markets are working. There could be his opinion, but I wanted to consider that for a moment. There was hedge funds getting out of the hottest market in tech stocks that weakened the market considerably, NASDAQ in particular. Then you had the catch-22 of the carry trade. People used to borrow from Japan to invest in other things. Japan started raising interest rates to control the slide of their yen to the dollar and try to control that so it didn't basically wreck the purchasing power and wreck their economy. And essentially what happened is people just stopped doing as much of that carry trade, borrowing the yen at cheap rates and using that to buy other things. They sold it back, and that caused a problem in the Japanese stock market and also caused less investment in the US stock market. So all of these stock markets and markets are essentially connected together. And when, I've said, when I wrote the book 15 years ago, Drop Shadow, I said it was either Japan or Europe that was going to lead us off into the next global recession. And it looks like Europe is having some issues, major issues, but Bank of Japan may go first. I don't know. It looks like their issue is getting worse with the yen, and it's forcing the central bank to do some things, which is affecting global capital flows around the world. So it's now affecting the US market. Now, will that US sell-off continue? Will it be the carry trade? Will it be weakness in the economy? What's the next catalyst? Brandon thought it could be politically motivated, and the Fed would cater to the politics of the election year and keep it boosted up and then pull away the punch bowl. That could happen. I don't know. We'll have to see. It's a theory. And again, we'll have people on the program in September to talk to us about that in the stock market and what those catalysts could be. Another article, this one from Zero Hedge, youth unemployment is being cited as one of the core drivers of the unrest in Bangladesh, which led to weeks of protests and Prime Minister Sheikh Hasina stepping down from office. As Statista's Anna Fleck shows in the following chart, and there's a chart which I won't show, labor force unemployment for people aged 15 to 24 in Bangladesh stood at 15.7% in 2023, above the world average for youth unemployment of 13.8% and the low and middle income average of 14.1%. Bangladesh is very high. Indian youth unemployment is high. Sri Lanka youth unemployment is high. And Nepal or Nepalese youth unemployment is high. Why am I talking about those regions of the world and youth unemployment? Think about the United States and all the youth unemployment. Will this eventually lead to unrest during the next recession? Absolutely. You're going to see the nation's youth out protesting because they can't participate in the economy at the same level everybody else can. The jobs aren't there. And by the way, this is a worldwide phenomenon. Why? I've talked about this over the years. I haven't brought it up in a few months, but we're going to revisit it. It's a demographic issue. As we get closer to retirement and people figure out Social Security is not going to do it, inflation's destroying the value of the stock portfolio, bond portfolios, real estate, all those things. The baby boomers, as they retire, are looking at their ability to retire. They sold this dream. If they worked for the same company and did all the things and bought the real estate and all the cars and were the consumer economy, that it would come back and help them at the end. They would have Social Security. They would have enough money to retire. They have Medicaid, Medicare, and it would all work out. Well, guess what? It's not. Even with all the government subsidies, even with all the money pumped into the stock market, into the real estate markets, the baby boomers can't necessarily retire. A lot of them can't. A lot of them don't have the income. And the ones that do have the income, they're realizing it's not enough. They're staying in the workforce longer, and they're doing it across the world. It's not only a U.S. demographic problem. It's definitely a Japanese demographic problem. It's definitely a demographic problem in Europe. It's all over the place. And what we're seeing now in South Asia, in these countries, in Bangladesh, India, Sri Lanka, Nepal, and a little bit less in Pakistan, is going to come to the US and Europe and around the world. They just lead it. Why? Because they don't have the world's reserve currency. So they see the effects of that before other people. But wait until the dollar starts having issues. The euro's already having issues. The yen's having issues. You're going to see this issue blow up, and it's going to lead to protests and things like that. Now on to general economic data. I think last week or the week before I talked to you about the issues with Home Depot and their outlook that sales should be down the rest of the year because do-it-yourselfers are not coming. Well, guess what? We have another one from Lowe's. According to Goldman's Kate McShane, provided clients with an earnings snapshot for Lowe's second quarter earnings. And it's that home improvement retailer Lowe's beat second quarter earnings expectations. Well, that's positive. They earned a little bit more than expected, but fell short on sales, slashing its full year outlook due to lower than expected DIY sales and a pressured macroeconomic environment. A pressured macroeconomic environment, lower sales. How they get higher profits? They cut everything they could cut. Lowe's and Home Depot have already been cost cutting because they've seen this coming in the data. And despite cost cutting, despite them earning a fair amount, overall sales are down, and they expect them to get worse because of a bad what? Economy. What is one of the canaries in the coal mine? Manufacturing and rehabs and construction. All of these things are being pummeled because people don't have the money to pay for this stuff. Sales decreased at Lowe's 5.5% year over year to $23.586 billion, below the Goldman Sachs estimate at 24.038 billion and a consensus of 23.946 from the other analysts. Comparable sales decreased 5.1% year over year as a decline in do-it-yourself big ticket discretionary and unfavorable weather was partially offset by positive comps in pro and online. So a little bit more online sales, a little bit more professional sales, overall sales down. Gross margin decreased 18 basis points. Total operating expenses decreased, inventory decreased. They're decreasing inventory because they're selling less. They're cutting costs. And even though the gross margin decreased, they were able to make their profit estimates, but they're predicting end of year it's going to be worse. McShane noted, although Lowe's missed expectations, we think this was somewhat expected after the Home Depot print last week. And the analysts are looking at it. Morgan Stanley has it overweight, meaning it's overvalued. JP Morgan has it overweight, and RBC is sector performing. It's going to mimic the sector. Well, the sector doesn't look good. So basically, those three analysts are saying it's going to get worse in the construction sector. Another area of the economy which is not doing well. And we go back to auto. Remember when I talked about Stellantis the last couple of weeks and how they were having issues, not able to make sales, getting rid of inventory that overstuffed. They weren't making sales or were looking at potential layoffs. Well, this week it's GM. CNBC reported Monday that layoffs at GM will affect at least 1,000 salaried employees globally in software and services division. The layoffs will include 600 jobs at the company's tech campus near Detroit. This comes 5 months after the automaker's software chief, Mike Abbott, stepped down, citing health reasons. General Motors continues reversing its pandemic-era hiring spree, during which it hired thousands of engineering software development employees to bolster its ambitions in the electrical vehicle space, the EV space. Well, guess what? EVs are crashing. I think I reported that before. The EV market is dying out. It's too expensive. People can't afford it. And now all these companies that invest in EV are now laying off their tech employees. That's also going to affect the tech sector in the NASDAQ. Remember the theme tech. Tech was overvalued. It was in a bubble. The price to earnings ratios of the stock to what the companies were earning was too high historically. I've talked about this now for 2 to 3 years about how it was overvalued. What's crashing first? Tech and industrial production and that type of thing. That tells you where we're going in the economy. In June, GM promoted 2 former Apple executives, Baris Setnock and David Richardson, to advance its electric, autonomous, and connected vehicles. Both executives were hired under Abbott last year. As we build GM's future, we must simplify for speed and excellence, make bold choices, and prioritize investments that have the greatest impact, the GM spokesman said in an email statement, saying, as a result, we're reducing certain teams within the software and services organization. We're grateful to those who have helped establish a strong foundation that positions GM to lead forward. GM cost-cutting measures come as concerns of an industry-wide downturn grow, particularly with the slowdown in the EV space. With interest rates at multi-decade highs and elevated new and used auto prices, affordability concerns persist among consumers. Do you hear a trend in the reports I've been giving you in 2024? The economy slowly is collapsing. And remember, when it happens, typically it's slow and then all at once. You get the waterfall. We're not at waterfall yet, but we're getting closer and closer. We got an election coming up. We got a tough Fed decision coming up. But we're having issues elsewhere in the world. When is this economy going to crash? Well, it's already crashing slowly and then all at once. What's going to be the black swan? A U.S. bank, a European bank, the crash of the yen, the further crash of the yen, a blow up of a sovereign debt like in Japan or in Europe. Many things. War could cause major issues. It's no coincidence that as the world economy starts to slip into recession, the data is clear everywhere that we're going to war, because what happens when the economy crashes? People get pissed off and they start shooting missiles at each other. That's history. It always has been. Dormant for a decade. We're going to go into uranium now. I used to report on uranium a lot, particularly a couple of years ago. It's been in a nice little, bull market. Did well for investors. Been up and down. But here's a little article on uranium I wanted to update you. This is from John Haughey via the Epoch Times. Since the Senate unanimously passed our Prohibiting Russian Uranium Imports Act and President Joe Biden signed it in law in May, at least 5 shuttered uranium mines across 4 U.S. states have been reactivated in response to accelerating global demand for nuclear-powered electricity. The latest reopening was UEC. How many times have I talked about UEC and uranium? Well, finally, UEC is reopening, which announced on August 13th that it resumed production in its Christensen Ranch in situ recovery operation in Wyoming's Powder River Basin, with plans to begin shipping yellowcake, milled uranium oxide, from its nearby 𝙎𝙁𝙍𝙀𝙎 central processing plant in December, noting that 94 nuclear reactors operating at 55 power plants currently generate 20% of the nation's electricity. UEC President and CEO Amir Adnani said the reopened mine will and processing plant is an investment reinvigorating a domestic industry that is vital to economic stability and national security. I've been saying this for years. It's finally come. For all the uranium investors like, oh my God, when's it going to happen? And all the pain over all the years, it's starting to happen now. It did help a little bit that we're basically sanctioning out Russian uranium to get that restarted. But honestly, uranium was going to go anyway because the world needs it. The world cannot survive without uranium right now in grid power. It's not possible. It's not possible till we can get thorium the way it needs to be and people invest in that. It's not possible till we find other sources of grid energy. You're either going to, for grid energy in the US, more than likely, you're going to use uranium, coal, natural gas, and then maybe a few other things mixed in where you can get wind and solar and hydro. There's not dependable or available everywhere, especially for grid use, which grid tends to be consistent use with peak use. And some of those renewables don't give you that. You have to have good old-fashioned fossil fuels and uranium. That's just the way it is. According to quote from the article, U.S. production has been virtually non-existent for many years, suffering from price-insensitive imports via foreign state-owned enterprises, blah, 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 blah. A quote. Uranium is coming back. All right. Now on to the sharing part of the program. We're going to show you some really cool exhibits. We're going to do this real quick because we're 20 minutes in. I've gone long, but there's a lot to share. This is the leading economic indicators. Remember at the beginning of the program, when I talked about economic indicators, where there's one which groups a bunch of them together and is actually called leading economic indicators. Some of them come out individual data points. This is one which economists do a general health check on the economy. Okay. 29 straight months down, leading economic indicators. 29 straight months. The worst plunge since the shutdowns in 2020. The worst plunge since the shutdowns in 2020. This started all the way back in 2021. The leading economic indicators, meaning what's going to happen to the economy in the future, when we look at these leading economic indicators, has been looking at a recession for 2.5 years. And there you go. And if you look at real GDP, it has fallen, and the indicators have fallen more, which means that GDP has to come down. What is holding up GDP right now? Mostly government spending based on debt, which is not productive and doesn't increase GDP productively, sustainably. It's just spending off of debt. So all of this GDP bump that you get here in real GDP, this dark blue line, most of that's government spending, not all, but most of it. And that incurs a debt, which is going to drag down the economy more. And if the government hadn't been spending, you may see GDP plunging, much like these leading indicators have been, because you can see there is a correlation. Not perfectly correlated, but a good correlation. What in the leading economic indicators is not doing well? The lending credit index is up slightly. The S&P is up slightly. Everything else is basically down. Interest rate spread, consumer expectations, new orders, building permits, manufacturers' new orders, non-defense, jobless claims. Most of the economic indicators aren't doing so darn hot. And a lot of them have gotten substantially worse through July, dating back 6 months. If you look at the right-hand side, a lot of these are really negative when you look at since the end of January to now. Not so hot. 2024 hasn't been great. I think we did talk about that. I wanted to talk about how that affects the population and poverty levels. Great chart here by Visual Capitalist. Now we're looking at percentage of the population that is has poverty rate. So the higher the number, the more poverty. So the highest one is 18.2%. The lowest is 7.1% by state. But if you look at the states, the South is where you're seeing a lot of poverty. Think about where the immigration's mostly coming from. It's coming this direction, from the South into the southern U.S. Why do we have poverty? Could it have to do with the millions of immigrants who are unskilled and can't find jobs living off of what the government, and what did I just tell you is the leading spend in the economy? It's the government. What are they spending on? Warfare and welfare. And your welfare state grows when you have more people come here and they're not educated, or they don't have skills, or they're not legal, or whatever the case may be. It increases poverty, and it's all down here. All down here. The Midwest tends to do the best right now. They probably have less of that immigration. They tend to have more stable conservative economies, meaning not overspending in debt, not talking about political party, but just not overspending in debt. And the places you see a lot of debt or a lot of immigration, it is cratering the average income, which is going to crater those local economies who can't afford the higher prices. Prices must come down. This is why real estate and stocks must come down. Nobody can afford all this stuff. We brought a bunch of people into the country that don't make a lot of money, and it's going to bring the average income for Americans down to the point which economy has to come down to match. Prices have to come down to match. That's why people are doing more Walmart runs and going to more dollar store runs. And even the Walmart and the dollar store are having issues because people are just running out of money because they're living on credit. And maybe as the government money they give all these immigrants that come through run out, they don't have any more to spend. Article here, Cointelegraph through Zero Hedge. I wanted to talk about the cryptos for a second. I said I would. Dubai recognizes crypto as a valid salary payment. From Cointelegraph, and a significant update of the UAE judiciary approach to crypto, the Dubai Court of First Instance recognizes salary payments in crypto as valid under employment contracts. What happens as the dollar becomes currency non grata, persona non grata? Nobody wants a dollar. They're getting rid of it, de-dollarizing. They're going to what? Gold, silver, and crypto. Crypto in the Middle East is there's a ton of development going on. I know a ton of crypto people that are telling me in the Middle East, in Asia, India, China, Southeast Asia, the Middle East, that area of the world is going nuts on crypto projects, blockchain projects. They're preparing for the modern economy using those technologies, and they're getting out of the dollar, and now they're allowing like Bitcoin and other crypto payments to employees. Why? Because it separates them from the dollar. When I said last year, 2023, when the World Gold Council came out and said all the central banks are predicting to hold less dollar reserves, everybody said, what are you going to do outside the dollar? You got crypto right there. You've got individual currencies of these nations. You got gold and silver. You've got gold and silver backed blockchain tokens in Zimbabwe. The world's going everywhere but the dollar. That's what this means. And looking at Bitcoin, Bitcoin's up more than gold this year. I graphed out gold as the green line, and then Bitcoin's the blue. Bitcoin is up 31% year to date, gold 23. Now, overall, Bitcoin's a lot more volatile, but I printed the chart to show you that as the rest of the world moves into alternative currencies, including crypto as one of their choices, it's keeping that crypto complex up. It's pricing it up. It's increasing demand even more this year than gold. Now, I think gold will have its day. I don't think this indicates on this short of a chart that crypto is taking over the role for gold. I think there's room for both. In fact, when the dollar blows up, there may not be enough gold and silver that people are forced into crypto because they have no choice. Plus, I think they're going to go to it anyway. Sovereigns are going into it. But at the end of the day, what we know is that everybody's de-dollarizing and they're going anywhere they can go, and they're running for the exits as fast as humanly possible. It's very interesting. All right, gold trade is down. This is a gold chart. The overall amount of open interest is down as we head into the summer. August can tend to be a very good month for gold. I've said that there can be fades in the summer. There can be a lot of times. August is one of those months. Sometimes you get a lot of investments. People come back. Usually it's the back half of August. We didn't get the typical fade in gold that I thought we may have. And, you know, to be honest, looking back on it, I understand why. You had more signs of weakening of the economy, more people de-dollarizing, things like that. Even though the U.S. retail public is not participating in this gold and silver rally, it's pretty much dead to them. The rest of the world is. It's going to sovereigns. It's going in big amounts. And that's being reflected in the prices. Not only in the physical trade, but the derivative trade. People are taking long positions because the hedge funds and the wealthy family offices and even the bullion banks to some extent are looking at gold going long for the rest of the year. So there's been an adjustment in positions, and that's why the prices are up. If you look at the data, 526,000 contracts are closed. That's a ton of contracts. 3,298 deliveries in August. That's a stupid amount of deliveries for a day. 3,298 gold deliveries. Look at how many contracts rolled off. 3,244. Basically, almost every contract, with the exception of 341 that were left open in August, got snapped up. And remember, this is the back half of August. When do most deliveries occur in any contract month on the COMEX? They occur in the first few days. In fact, they occur in the first couple of days leading up to the next month because you get a 2-day head start, 2 business day head start before the coming month to declare your intention to take delivery. It gives people time to deliver by the first of the month. There's basically a 2-day window on average for the COMEX. That's kind of how the system is designed to flow. So typically the first 2 days leading up to the month and the first 5 to 10 days of the month, usually first 5 to 7 trading days, you get all the deliveries. We're sitting here on the 20th, and within the last 24 hours, been 3,298. That's insanity. Why are people going for gold any way they can get it? If they can find anybody to deliver gold, they'll do it anytime they can do it. People want physical. Look at the EFPs. That's going to London for the physical. 4204. That's a pretty damn big print for a day. I mean, I've seen them bigger. I've seen them 15,000 in a day. But that's a hefty amount of gold. Both being delivered and going over to London and say, hey, guys, knocking on the door in the UK. Hey, guys, do you have it? Can you give us some gold? Look at the Clearport. What is Clearport? I'll read it to you. It's privately negotiated trades, which may be reported through Clearport CME Group's clearing service for over-the-counter markets or directly into CME clearing. So in other words, it's an OTC version that you can put into the CME, much like the London market's OTC, over-the-counter, that you can do a privately agreed trade and then just stick it on the exchange. Why are those been up? Private agreements on gold. Why private agreements on gold? Everybody freaking wants it. Block trades. A block trade is essentially just traders trading blocks, but they're trading them kind of off the market and bringing them back on, or they're doing like a bulk trade all at once instead of going to the market and trying to do it real time. Trade after settlement. What are trade after settlement? It's an order type that specifies the day's settlement price as an order price. In other words, they wait till they get the daily price. They lock that in so they don't have to do with the volatility of the market and go see if somebody has that gold that they want, and they just agree to somebody at the end of the day price, put it on to the market the next day. These are all indications people are hunting for what? Gold, and they're hunting for certain prices in gold that they're not getting in the American market. Overall, hefty trade, 420,000 contracts. That was Monday. Friday, here are the numbers: 74.93 EFPs over to UK. Modest 80 deliveries, lots of block trades, and lots of Clearports. 15,000 contracts for the day for those sort of off-market or privately agreed trades. EFPs 34.59 on Thursday. You see a trend there with gold? Going to settlement, the only reason I show that is just pricing. This is where the price is determined. Up $3 Monday, Friday up $45. It's a paper traded market. That's why I show it. I wanted to look at the ETFs because where is all this gold demand coming from? Because yes, there's physical deliveries going on, but the American retail is not going into coin shops. They're not ordering for MAPMEX all this gold, but there is gold demand. So when I said retail is not participating, they're not participating directly in physical. There is some investment from funds into gold. This could be some sector rotation. See all this green that we've seen, especially green on this day, on the 16th, $565 million worth of gold investment into GLD. Now, technically, GLD is supposed to have that gold and put a receipt on it and say this is allocated to the trade, but they don't necessarily have to in their prospectus. It's not physically deliverable, so they don't have to have it at the time at which they accept the trade. So there's a bunch of retail trade coming in here. Why into the ETFs instead of physical? It's rotation from other funds. As you see weakness in the stock market, people are going into the ETFs. Maybe they're proceeds from sale of real estate or whatever. People are going to gold. They're just doing it in electronic format. They don't realize maybe, because they haven't read the prospectus, they can't get the physical, but they're getting exposure. So there is some retail demand, but it's in the paper markets. It's not in the physical. This is typical because the paper markets will get bid up first, especially these higher prices, because people feel like they can get in and out and trade it quickly versus having to go to their coin store or package it and send it back up to the online dealer. And so they'll do this, but as the demand for gold grows, they'll get more into physical. This is kind of consistent with that pattern. We'll see what happens the rest of the year. So there is some retail trade, but they're trading out of other assets they already invested in into these. They're not taking cash that they don't have from their paychecks and putting it into physical. They're sector rotating. We're starting to see sector rotation. I said this would happen as the gold market got deeper into this bull run. What about silver? Let's go over the futures. Volume and OI higher than in gold, a little bit more frothy. In terms of deliveries, you only had 14 in silver. You did have 1120 FPs over to the UK. You did have some Clearports, a few block trades, a few trade after settlements, those sort of off-market or pre-agreed trades that get put on the market in various ways. It's not as frothy in silver because silver is still mostly demanded as an industrial commodity, and there's some investment in as money or as an asset. There's more in gold than silver. If we go look at the ETFs, silver got really demanded up in July, but now it's gold and silver's kind of fallen off. So there was some investment in silver into SLV, some retail, maybe even some rotation by some hedge funds and financial houses. Okay, fine. But trading a paper asset for another, maybe proceeds of sale of one asset into silver, who knows? The defensive positioning by the retail market, but not with new dollars mostly, not with cash going to the coin store, that type of thing, which is typically how Americans like to buy it. Now, the younger generations do deal more in the ETFs than the physical in gold and silver, and it may be some of the younger generations as well. They don't have a ton of money. So I'm suspecting giving that data and giving what we've seen in the stock market, people are rotating out and kind of repositioning a little bit in the metals. This is early adoption of metals positioning. Eventually will lead to more actual physical demand. At least that's what's seen in previous markets. Going back to the charts here in silver, this is just, I just show the price. Here's a change up 46 cents for Monday. This is how prices are determined. I just show it so you know, it's not physical trade. It's that market. Last bit, 𝙍𝙍𝙀𝙀 at Oriental_Ghost on X is the best guy to follow in terms of the China daily report. The one thing I wanted to point out is that silver's trading higher. This is silver, 32.71 an ounce in US terms, in US currency, US valuation, which is higher than the 28.29 that we had going on in silver recently. So the Chinese market's pricing higher. Gold was priced slightly higher too as well, although the discrepancy is higher in silver. I think that indicates that in the East, in Asia, they know that silver's running out, critical mineral, they're investing in it. I know the Indians are investing a lot in silver because of some impediments to owning gold by the government, but also it's cheaper. So a lot of Asians are buying more physical. That's why in that physically traded market in that area of the world, you're seeing more demand and higher prices. An indication of what's to come. And I gave you a lot today. Let's recap. I talked about the overall economy and how it was doing, sort of that slow slide down. I talked about the carry trade, and we talked about how that carry trade affected the US market. It didn't only affect investment in Japan, it affected what those dollars borrowed from Japan in cheap currency over there led to a pullback in the US stock market. We also talked about how the techs were suffering a bit because they were overpriced and people were pulling out. Some of that's rotating in gold and silver ETF form. Some of it's probably going to pay off debt or whatever. Overall, the economy is sliding down. You can see it in the numbers. We're seeing what's happening in the gold and silver trade. The US retail is buying ETFs. They're not buying physical as much here. That market has not kicked up. I know some people are on YouTube trying to tell you that US retail is buying a lot of gold and silver. They're not right now. We're still in retail capitulation. They're still net selling their necklaces and their bars and their coins. I know. I see the prices every day from the wholesalers. I'm still connected to that market. I still do some sales. I still see a lot of the trade data. I see a lot of the online chatter. And the retail market physically is not strong, but it will get stronger. We're starting to see sector rotation into the paper forms. That leads up to the physical. It could take a little while to get there. The Fed is in a tough spot leading up to the election. They almost have to cut once. The market expects it. Personally, I think they're taking the marching orders from the BIS, so they're going to do what the BIS says. That's why the people in the US get so frustrated, and Congress gets frustrated, and the president gets frustrated. The Fed does not answer to them. It answers to the guys across the pond. And that's why their policy doesn't seem to make sense. People make every excuse for the Fed doing something that seems to make sense. But now what the Fed doesn't make any sense to anybody in America anymore because they're not taking the marching orders from the US government. They're not beholden to them. They're owned by mega banks. It's a private institution with some government, appointed people. But the head guys take the marching orders from the BIS. I've talked about that countless times. I think... in fact, the BIS people, I think this month sometime are coming to the US to meet. And I believe it's is it Jackson Hole? I can't remember where. But they're not going to talk about that on the news, how the world's central bank leaders come here along with BIS people, and they all plan what they're going to do. They do it on our soil, and it's not necessarily benefit Americans. And overall, we expect weakness in the stock markets. We've started to see some weakness. That will continue. We'll examine that more in September as we prepare for the last quarter of the year. We'll give you a preview on that. We'll bring some people on the program. That's what's going on. It is a very mixed market. There's a lot of volatility. The summer was kind of a calmness, the eye of the storm. Once we get to election season, I expect things to go kind of nuts on the geopolitical front, on the election front, on the economic front. I don't know what we're going to see the back half of 2024, but a lot of analysts I see are predicting major issues in the economy, major stock market issues, possibly pressure on bonds. And you saw the whole world trying to do what they can to hedge their exposure to the US dollar and the US treasuries, the bonds, by getting into cryptos, by setting up alternative banking arrangements, trade agreements. It's getting real across the world, and you can see it. And you just have to look at those daily signs to know what's going on. Sometimes when you're looking at the economy, you follow it long enough. It's kind of like you can read the Matrix. You kind of see what's going to happen before it's going to happen, at least an idea. You don't know every little detail. It's too complex, but you know the big points. And that's why as you come on Tuesdays to watch this program, if the only program you ever watch is my Tuesday market report, it's designed for the purposes of getting you up to date so you know what's going on so you can prepare. Prepare. However you feel is best. I'm not your financial advisor. Do what you think is best. I'm a gold silver guy. You do what you think is best, okay? Don't listen to me. Do what you think is best. But take the data I give you and consider that as part of your research. And do what you can do to protect yourself. Usually, because I'm looking at the data, I can see things months, sometimes years ahead. And stay tuned to the program on Tuesdays. We've got other great content. This Thursday, we've got a couple of things going on. But this Thursday, the video is going to be Kinesis. I'm bringing on the global brand manager for Kinesis to talk about it and demystify what Kinesis is. Kinesis, it's gold, silver. They have the bullion. They have an electronic version of it, tokenized version of it, audit, all that stuff. That kind of freaks people out, so I'm going to talk about that. But much like I had the Goldback interview last Friday with the CEO, Jeremy, I wanted to have a representative of Kinesis on to talk about gold in that form. Why am I talking about alternative forms of gold? I've talked many times about how if you have a coin, if somebody has a coin, and you pay different premiums and they're different coins, that you can't trade sometimes with them. The coinage that we have, the modern coinage, is not necessarily designed to be coinage. It's designed to be reflective of cool designs. It's collector's items. The modern eagles or the premiums often are collector's items. The U.S. Mint puts out eagles and all these fantastic packages and turn them into a collector item. It's not money. The last time we had silver as money was really 65. Some issues of like $0.50 to 69, Kennedy's 40%. But for all intents and purposes, silver and money ended in 65 and gold in 33. Okay. Almost 100 years for gold. What is that? 60-ish, whatever years for silver. We don't have a readily available way to trade on an even exact basis, gold and silver in the economy. So Goldbacks, Kinesis, these systems are designed to solve that problem. Yes, you should probably still hold some. If you're a gold and silver holder, you've already made that choice, okay? Not your financial advisor, but you decided that. And you decided I need to have some at home or in a safe down at the wherever. However you're doing it, secure it, bury it in the backyard, whatever. Fine, I got no problem with that. But if you take it all and do that, you run a lot of risk, home invasion risk, and you're guaranteeing it can't be money. We need to circulate it. That's one of the things I'm trying to do. I'm trying to give you alternatives. It's hard, having owned a coin shop and been in this space for 15 years, it's real hard to trade different denominations and different premium values of different products. People will sit there and argue for 10 hours at a coin show or all weekend at a coin show before they'll trade 50 cents in silver for 48 cents in silver. They would rather argue for 3 days than take a 2-cent hit. There's no way that turns into a functioning economy. The coins will help, but we need denominations and methods. Okay, so Thursday we'll talk about Kinesis. I'm doing also another video on CBDCs with 2 guests. I'm going to have a roundtable on CBDCs. We're going to record that hopefully this Friday, have it on the channel next week. I'm going to bring you 2 experts on this, 2 guys who have been following us for a long time. Now, I've done my videos in CBDCs. I'll bring that to you when we do our CBDC video next week. I'll show you my videos, but I want to give you 2 sources of information that I've used and that I think you'll find very valuable. We're going to talk about all the latest developments. A lot of the developments you've seen on other channels, I told you about months ago, and I told you months ago other channels will start carrying them. Well, I know some of those channels carried them because I went to those channels and said, here's my guy, listen to him and put it on your channel. So you saw it on my channel first. You've now seen it on other channels. And now we're bringing the conversation back to the Freedom Report to talk about CBDCs again, but this time with a roundtable. I haven't done a roundtable in a while. I think it'll be a lot of fun. I think you guys will enjoy it. CBDCs are the reason why we want gold and silver circulating as money. It's the reason we want to do the legislation. It's the reason we talk about gold and silver. It's the reason we talk about honest money, sound money, the economy. This whole Tuesday report is set up to educate you so that you understand what's coming next, so that you can prepare yourself. So we've got to bring it back around to CBDCs again. I haven't done that video in a while. We'll do that in detail. All right, we're running 45 minutes. That's really long, longer than I intend to go. So I'm going to wrap this up. Thanks, guys, for joining the Freedom Report. Follow me at freedom_RPT on X and Freedom Report right here on YouTube. Thank you guys so much. Until next time, Rob Keynes.